Number 26, IE and IFS theory portion, insurance company, completely in English. So let's get started. What are the topic which we have to study in this particular chapter? Objective, introduction, history and development of insurance, privatization and FDI in insurance sector, insurance business globally and in India, insurance penetration and density, number of insurance company operating in India, legislation governing operation of insurance company, insurance intermediary, reinsurance, and then insurance repository. So we will try to cover an e-insurance account. We will try to cover this 11 topic in two part. Basically from 26.1 to 26.6 in the first part and remaining one in the second part. So let's get started with our introduction. So friends, have you ever wondered how insurance work? Let's break it down in the simple term. First of all, insurance is a kind of contract. As you can see clearly written, is a kind of contract. So basically contract means, it is a promise for protection. You can say it is a kind of promise for protection. Basically what you do, you pay a small fee that is called premium. You pay a fee that is called a premium, and in return the insurance company promise to help you financially if something bad happen. If something bad happen, the insurance company promise to help you financially. Let me give you one example. For example, suppose you have car insurance. Suppose you have car insurance. Okay. And the car met with an accident. What happened to the car? The car met with an accident. So what will happen? The insurer pay for repair. So the insurer, what he will do? He will pay for repair. He will pay for repair. Right? Minus any deductible. So that is what we call, insurance. It is a kind of contract, means promised for protection, and you have to pay some premium if anything bad happen, right? So that is the point. I given you one example of the car, right? So if you have car insurance and that car met with accident, the insurer pay for the repair. Now the next point is, it is formalized through a policy. I hope insurance concept is clear. Contract where the insurer promised to compensate the insured for financial loss. Two words you will see, insurer and insured. One who is giving insurance is called insurer, and one who is getting insurance and who is paying premium is called insured. Okay, insured is paying premium. Now it is finalized through a policy, which means, the detail of this agreement are written where? The detail is written in an insurance policy. Okay, so this policy is a kind of document that explain what is covered, what is not covered, and how much you will be paid in case of loss. Everything detail is written in the insurance policy. Let's say a health insurance policy. Suppose there is a health insurance policy which lists down which hospital bill it will cover and up to what amount. The next is, it cover the unpredictable losses. And one more thing, basically unpredictable loss, only unexpected event. So insurance does not cover things that are certain. Certain things are not covered. Remember it. There are some things which are quite certain. Such kind of things are not covered by insurance. Rather, it helps with certain unexpected kind of loss. Like suppose some kind of theft happen, or suppose some kind of accident happen. So that is what insurance cover. Okay. This is the key point which you must keep in mind. Now, friends, for example, home insurance won't pay for a leaking pipe due to poor maintenance. Suppose maintenance is not poor and because of that a pipe is leaking. So home insurance will not pay for it. But it will cover damage from a sudden fire in the house. So it covers unpredictable loss. It does not cover the certain and predictable loss. Obviously, if your pipe is leaking, there is a maintenance issue and that is a kind of predictable thing. So insurance will not cover such kind of thing. It only covers the unpredictable loss. And if such kind of loss occur, it will offer the reimbursement. And who is involved? Let's answer this question. Who is involved? So basically, the insurance ecosystem is there. So their first one is the insurer. Insurer means what? The company that provide insurance. Company that providing the insurance, like LIC. LIC is the company that is providing the insurance. Second is the intermediary, which means agent or broker who help you buy policy. So there are some agent, there are some broker who help you buy policy. They are called intermediary. And finally we have the IRDAI. IRDAI is the government body, like a referee, that ensure that insurance company play fair. So these are the government body or like a referee. Okay, so let me give you one real life example of it. Suppose Rahul buy a bike and get it insured. Rahul is a person who buy a bike and get it insured. One day his bike got stolen. So since he has insurance, he can file a claim, right? The insurer verify the loss. The insurer will verify the loss, and the insurer will compensate Rahul as per the policy. And without insurance, Rahul would have to bear the full cost himself. So let's summarize what we have just discussed now. I told you that insurance is a kind of safety net. Insurance is a kind of safety net. Okay, is a kind of safety net for financial loss. Is a kind of safety net for what? Financial loss in exchange for a premium. I told you about policy. What is policy? So policy is a rule book. Policy is the rule book that define the coverage. Yes, we are covering this much, that is defined under policy. And one more thing I told you, that only unpredictable loss are covered, right? Not regular wear and tear, right? And the key player are, I told you who are the key player. One is the insurer who is providing insurance, other is the insured who is paying premium, other is the agent, and the fourth is the IRDAI. These are the key player. Remember, these are the key point. So the next time you hear about insurance, remember it is like having a backup plan for life surprise. Obviously life will offer you several kind of surprise, and you should have a backup plan for that. Okay, I hope that makes sense to you. Now let's talk about the history and development, right, of this insurance. Okay, so friends, did you know that insurance is not a modern idea? It has been around for thousands of years. Let's take a fun trip through time to see how insurance started and how it became what it is today. First of all, if we talk about the ancient roots, have a look at it. So let's start with the ancient root. So insurance in the olden day, ancient Indian text like Manusmriti. You might it is a kind of ancient text, Manusmriti, and Dharm Shastra. The Manusmriti and Arth Shastra. What they do? They mention community help during crisis, like farmer pulling grain for drought. For example, imagine a village is there, right, where everyone contribute a handful of rice to a common fund. Everyone contribute handful of rice to a common fund. So if someone crop fail, they will get help from the fund, just like insurance today. Suppose someone crop get failed, just like insurance, from the common pool they will get the fund. That is the main purpose of collecting a small quantity of rice and putting them in the common pool or fund. Now then we have the early trade. So traders selling risky sea routes using marine trade loan. If ship sank, the lender would forgive the debt. Suppose ship gets sank, okay, the lender would forgive the debt. This is a kind of risk sharing. For example, a merchant borrowing money for a spice shipment would not have to repay if the pirate attack. It sounds like a cargo insurance, right? So suppose some pirate attack on the ship, and the ship is carrying some kind of spice, okay, and merchant borrow money for a spice shipment. So they would not have to pay if a pirate attacks. It sounds like a cargo insurance, right? Now then we have foreign influence and first insurance company. Yes, have a look. So the British brought modern insurance to India, and the first one was the Oriental Life Insurance Company in 1818. It was India's the first life insurer. This was the first life insurer. The name is Oriental Life Insurance Company. And it was established in the year 1818 in Calcutta. And who are the other pioneer? Other pioneer are the Madras Equitable 1829, Bombay Mutual 1871. So back then foreign company like UK firm dominated the market. This foreign firm dominated the market, making it tough for Indian insurer to compete. Provide stiff competition to the Indian company. I hope that makes sense to you. Now friends, have a look at the regulation and reforms. So what were the regulation? In 1912, what happened? The first law was passed, right? That was called Indian Life Insurance Companies Act, to regulate the insurer. What is all about? To regulate the insurer. This was the first line, first law which was passed in 1912. Then comes 1928, right? 1928, where the Indian Insurance Companies Act was commenced. It allowed collection of data for both life and non-life insurance sector. Then comes 1938, where Insurance Act introduced a stricter rule to protect customer from fraud. So this Insurance Act 1938, it introduced a strict rule to protect customer from fraud. And then we have 1950 Insurance Amendment Act, right? What did the government do? The government banned. What the government banned? Principal agencies. So principal agency, they are like middlemen. They are like middlemen who controlled policy unfairly. So the government banned these, principal agent who controlled policy unfairly. That was done in 1950. So then we have the nationalization. So the government take charges. So due to scams, 1912 first law was passed. In 1938 Insurance Act introduced a stricter rule. In 1950 principal agent was banned by the government. And then comes nationalization of life insurance. Means government take charge. Okay. So due to a scam and unfair practice, the Indian government nationalized insurance in 1956. 19 January 1956 to be more precise. So life insurance was nationalized in 1956 and general insurance was nationalized in 1973. So these two years you have to remember. First one is 1956, which is about LIC, and GIC 1973 GIC. Just like how RBI monitors bank, similarly the government took control to ensure that everyone get fair treatment, right? So you can think of like Ramesh. Suppose Ramesh is a person, okay, and he is a trader in 1800 Bombay. Okay, so he buy insurance for his ship carrying cotton. So his ship was carrying cotton and he bought insurance. If the ship sink, the insurance company compensate him just like it worked today. The rule evolved over time to protect people like Ramesh from greedy company. So now let's quickly recapitulate. First of all, I told you about ancient insurance. You remember ancient insurance example? I told you community supporting system. Okay, then we talked about the marine loan, right? So like basically this was like early insurance for trader. After marine loan, we talked about first company, that is Oriental Life Company, 1818. Okay, and then we talked about Bombay Mutual Fund. So Bombay Mutual was in 1871. Okay, then we talked about the foreign dominance. So I told you about UK firm ruled the market initially. Yes, I told you that UK firm, they ruled the market. And then we talked about the regulation. What about regulation? The law was passed in 1912. Law passed in 1912, 1938 and 1950. In all these years, law were passed to protect the customer. And finally, nationalization happened in 1956. Okay, so these are the key dates you need to remember. Now, if we talk more detail about the nationalization of the insurance, as you can see. So what happened in 1956, the Indian government took over the private life insurance company. Why? To stop unfair practices, to ensure stability, and to make insurance accessible to the public. What was the result? The result was that LIC, Life Insurance Corporation, was born. And it was born merging 245 companies. It was born merging 245 companies. And these companies include Indian company, these company include foreign company, and these company also include Provident Fund. Okay, so these basically 245 companies into one giant entity. You can see 245 companies were merged and one giant entity like LIC was formed. Example, you can think of it like merging 245 small Kirana store into one big Reliance retail of the insurance. Now comes the monopoly. Here you can see monopoly. So basically, LIC was the only life insurer in India for about 40 years until private players start entering in 1990s. So that was the monopoly of LIC. For 40 years, LIC was the only single life insurer in India. Then comes the general insurance. So how it started, you see. So began at Europe. If we trace the history, it began in Europe. General insurance began in Europe in 1700 to protect the factories, shops, ships and goods. So here you can see why it was done. So the main reason was to protect the factories, to protect the ships, and to protect the goods. And if we talk about India's first general insurer, so which was the India's first general insurer? Triton. Here you can see the name written, right? Triton Insurance Company 1850. This was the India's first general insurance company, first GIC, right? And then followed by Indian Mercantile Insurance Limited in 1907. It was first to cover all type. So it was first to cover all class of general insurance, like fire, like marine and theft. For example, if a 19th century trader ship caught fire, general insurance would cover the loss just like today. Then comes the nationalization of GIC. This was the birth of GIC. Okay, now in 1973, you must remember, in 1973, it was the time when GIC born. Why? Because same issue as life insurance. Too many a small player were there, right? A small player were too much. And I told you some unethical practice were also followed. Some unethical practices were there. So because of these reason, small player, unethical practice, GIC was nationalized. And what was the change? The change was that, 1972 law was passed. Means government took over 107 general insurer. There were 107 general insurer. Okay. And what government did? Government took over them. And they merged them into 4 big company. Okay, so this 107 general insurer were took over and they were merged into 4 big company. And these 4 big company were under the General Insurance Corporation of India, or we call it GIC. Remember it. Okay, let me give you one example. For example, imagine 107 a small YouTube channel merging into 4 big network like a Disney or Sony. Just an example I am giving you. Now, if we talk about the real life collection, the scenario was that let's take back the example of Ramesh. So Ramesh buy a truck and insure it with UIC. What is UIC? United Indian Insurance. This United Indian Insurance was one of the 4. I told you there were 4 nationalized company. Out of them, one was UIC. Now, if his truck met an accident, he will get cover. Thanks to the government move to make insurance reliable. It was indeed a government move to make the insurance reliable. So now let's summarize the fact which we have just covered. First thing first, we talked about 1956. What happened? LIC was nationalized. Okay, and basically life insurance was nationalized. Sorry, not LIC was nationalized. Life insurance was nationalized and LIC was formed. LIC was formed in 1956 after merging 245 company. Okay, then after we talked about general insurance. Right, what I told you was insurance company. So general insurance was nationalized in the year 1973, right? And there were GIC were formed and its 4 subsidiary were also formed. Why nationalization? Then the reason for nationalization was to stop the fraud, because fraud were going on. Okay, and to ensure stability it was nationalized, and to make insurance public friendly it was nationalized. So these were the key reason behind the nationalization of this life insurance as well as the general insurance, right? So LIC tagline is Jindagi ke saath bhi Jindagi ke baad bhi become iconic because it was the only life insurer for decades. Now have a look at the next point, that is the privatization. And we were talking about now the privatization and foreign direct investment in the insurance sector. So friends, the year 2000, it changed the India's insurance game forever, because private company and foreign investors were allowed to enter, making insurance more competitive and innovative. That was the key change, right, which were made in the year 2000, opening to private player and FDI. So let's see how this shift happened and where India stands globally. So first of all, the comes privatization and FDI in insurance. Yes, privatization and FDI in insurance. So basically, in the year 2000, global government allow private player plus foreign investment FDI with 26% cap. So initial cap was kept up 26%. So government allow private player plus foreign investment with 26% cap. And in 2015, that FDI limit was increased to 49%. Right. So what happened? More foreign money flowed in. And then further, FDI limit was hiked to 74%. That means foreign company can now own and control Indian insurer. Right. Earlier it was just 49% and now it is increased to 74%. So that a foreign company can now own and control Indian insurer. So this was a progressive increase in FDI cap. For example, it's like foreign brand like say Starbucks, right? So it is opening a store in India, but now being allowed to own 74% of them instead of just 49%. So earlier you can see cap was just 26%, then FDI limit increased to 49%, then increased to 74%, and now it is 100%, I think, right? And 100% FDI in intermediary. One more thing is there, that in 2019 broker web aggregator like Policy Bazaar can be fully foreign owned. Okay, so these are the web aggregators. So you can see here 100% FDI in intermediary. In September 2019, insurance intermediary can receive up to 100% FDI. Who are insurance intermediary? You might have heard the name of Policy Bazaar, right? So this Policy Bazaar is what? So basically they can be fully on. So 100% FDI are given. Now the question is why FDI matter, right? So the question is why FDI matter. This is very, very important question. So basically, that more money, it means more growth. Simple, right? If it is more money, it means more growth, right? So foreign investment help insurer expand, improve technology, right? And then offer better policy. So the first reason FDI matter, why FDI matter is better product, which means competition from global player like you might have heard the name of AXA, you might have heard the name of Allianz. So these are the global player. So competition from this global player forced Indian insurer to innovate. For example, earlier LIC has no competition. Now company like HDFC Life, ICICI Prudential, they offer customized plan, right? Now if we look at these were the reason why FDI matter. Okay, now the question is that India's insurance growth versus global market. Yes, how can we compare? So if we talk about the global insurance market in 2019, if we talk about, so it was worth how much? 6.3 trillion, right, dollar, which is the 7.2% of the global GDP. This is the global insurance market in 2019, worth 6.3 trillion dollar. And if we talk about the India's share in that, right, just 1.69% India is accounted for that, but it is growing very fast, right? You can see 9.21% growth is there of India versus 3% growth of the overall world. Yes, obviously the share is very minimal, 1.69% of the global insurance market, but it is growing at very fast. You can see it is growing at 9.21%, outpacing the global average. Global average is just 3%. Now if we talk about the life versus non-life comparison, so you can see globally what is happening, that non-life like car, like health, these are non-life insurance. So globally non-life insurance dominate almost 53.66%, but in India life insurance rule is 74.94% share, because Indian prioritize saving plus security. This is what Indian prioritize, right? But in the other global perspective, we talk about non-life insurance, they prioritize, they dominate. Fun fact is that India is ranked 10th. Here you can see India is ranked 10th in life insurance, but only 15th in non-life insurance globally. And the big insight is that low penetration and high potential. Here you can see low penetration. You can see in insurance penetration is very low. Only 4% of the Indian have insurance versus global average of 7%. You can see 4% of India. In India, only 4% of Indian have insurance, and global penetration is how much? 7%. So it clearly indicates that penetration is quite low. But future scope is high. Why future scope is high? The future scope is high because here you can see, right? It is high because rising income and awareness. It means massive growth ahead. Now, if we talk about the scenario of 2024, let's have a look. So for real life collection, let me give you one scenario. Suppose Priya bought a term plan. Priya bought a term plan from Max Life, okay, and which is a private insurer. She gets a lower premium thanks to the competition. So the app-based process is possible because foreign investor funded technological upgrade. So let us just summarize what we have gone through in these two particular slides. So just now I told you that that 2000 in the year 2000 private player. Right, private player plus 26% FDI cap was allowed. Okay, then comes 2015 to 2020. what happened? FDI increased to 49%. Further, it includes 74%, and if foreign control was permitted. Then comes 100% FDI in intermediary, right? 100% FDI in intermediary, like policy bazaar. 100% FDI was allowed. And if we talk about the global market, India's share very small, right? If we talk about the global market, so India's share, how much? India's share is 1.69%, but growing fast growing 9.21%. It is growing. And life insurance dominate in India. Life insurance dominate. I told you, na? Life insurance dominate. Right. If you talk about percentage, it is almost 74.94% or 75%. Future is there, huge potential is there. Now have a look on the insurance penetration and density. See what that is mean, insurance penetration. Have you ever heard the term like insurance penetration and density thrown around but did not understand what they mean? Don't worry, because question based on this is most frequently asked. Let's understand every aspect of it. So what is insurance penetration? Basically, it is the ratio of total insurance premium. In the numerator, we write the total insurance premium, and in the denominator, we write the India's GDP, showing how much insurance contribute to the economy, right? How insurance is contributing to the economy. So we write insurance premium to GDP, right? So this ratio is called penetration. So for example, suppose India's GDP is 100. Suppose India's GDP is rupees 100 and insurance premium are rupees 3.76. This is the premium of insurance and this is the GDP. Okay, so what will be the penetration? This penetration is 3.76%. Right. So you can think of it like measuring how much of your salary you spend on insurance. Suppose you earn 50,000 rupees per month and pay 1,000 for insurance. So your personal penetration is how much? 2%. Similarly, insurance penetration is measured in terms of GDP. What is the GDP of India? Suppose 100 rupees is the GDP of India, and how much premium they are paying? 3.76 premium they are paying. So insurance penetration is 3.76%. So I hope it is clear. Like in the terms of salary, I also explained. Suppose your salary is 50,000 rupees per month and you are paying 1,000 rupees as insurance. It clearly means your insurance penetration or your personal penetration is 2%. Now what is insurance density? See, it is the average insurance spending per person. So we can call it average insurance spending per person, right? That is called insurance density. Let me give you one example. It is always measured in terms of dollar. Remember, for example, if India's population is 1.4 billion, suppose India's population is 1.4 billion and total premium are $78 per person. Total premium is $78 per person. So what is the density? So density is how much? Density is $78. Right. So let me give you one example to make it more clear. Again, I am repeating. Suppose India's population is 1.4 billion and total premium are $78 per person. Density is 78 billion. That is quite clear. One more thing I want to tell you, that if suppose 10 friends are there, let's take one example to make it, to just to take real life example. 10 friends are there. Okay, 10 friends are there and they pool 7,800 rupees for insurance. So what is each person density? It is nothing but 780, right? That is called density. Means per person, average insurance per person. That is called density. So for that you need to know the population of India, which is almost suppose 1.4 billion population, and total premium is suppose this much. So divide both of them, you will get the density. Okay, that is the point. Now if we look at the trend that India's insurance penetration, first of all let's look at the penetration trend. So what is the meaning of penetration? I just told you. Penetration simply means that total insurance premium to India's GDP, showing how much insurance contribute to the economy. That is called penetration, right? So if you look at the penetration trend, you can see in 2001 the penetration was 2.71%. Okay, it contributed, insurance premium contributed 2.71% to our country growth. However, why? Obviously in the year 2009 you can see it grew to 5.20%. Now you might ask me, you might think how it rose. What was the reason behind it rose? So it was jump due to privatization, right? I think we have discussed it. It was privatized, right? Due to the privatization and awareness of people also increased, and due to privatization this penetration increase. And if you look at the 2014 data, it further declined to 3.30%. Why? Because our economy was quite slow there at that time. You might have heard about economic crisis right? Economic crisis, economic slowdown, and this economic slowdown caused it to plummet to 3.30%. And further in 2019, it grew again to 3.76%. It recovered. Why? Due to some digital policy which were adopted, right? And more insurance. And you know, penetration is still low versus the global average. Global average is how much? 7%. Right, meaning huge untapped potential is there in this particular market. So that is how penetration has moved. And what is penetration? I already told you. Penetration simply means how our premium is contributing to the economy. And if you look at the progress of density, so you can see the trend in the year 2001 it was just $11.5, and in the year 2010 it rose to $64.4, right? So why it rose? Because of the rise in the income and policy. Due to the income rise, due to the policy rise, right, it increased. Now in 2016 what happened? It further dipped slightly, and in 2019 it reached $78 because more people buying insurance. Okay, so that is the point. Our density is what? Insurance premium per person, that is called density. Okay, so that is the trend of penetration and density. Okay, and then we will look at the 2019 sector breakdown, that how much is the life insurance, how much is the non-life insurance. So if you talk about the life insurance first, you can see the penetration is 2.82%. Means most Indian prioritize life cover, right? Most Indian prioritize the life cover. And density you can see at $58, means higher spending on life policy. If you look at the non-life insurance, so just like for example I give you health insurance, car insurance, right? These are non-life insurance. So penetration is 0.94% and density is $19. So the key insight is that India's focus more on life insurance. I think I already told you. You can clearly see now life insurance penetration is quite high, density is quite high. Non-life insurance penetration is low and density is also low. So India is focused on saving and security. India most focused on life insurance. So India focus more on life insurance, and life insurance means saving plus security. Okay, then health or car insurance. India focus more on life insurance, means saving and security, then health and car insurance. That is the inference that we can draw from this particular thing. So let me give you some real life collection. Rahul is a 30-year age person in Mumbai. Okay, he earned rupees 10 lakh per year. Suppose he earned rupees 10 lakh per year. Now see, he has spent 28,200 rupees on life insurance, right? Which is almost 2.82% of his income. He has spent on life insurance. It matches the national penetration. Also, he has spent 9,400 rupees on health and car insurance. This I am giving you data to just understand. So which is how much penetration? 0.94% penetration. Isn't it? Because penetration is simply what? How do you find the penetration? Just now I told you the formula of penetration. You remember it? So what we do to calculate the penetration, we write the GDP in the denominator and we write the premium in the numerator. Like in this case, he is paying per year 28,200 rupees to LIC, right, on life insurance, and total earning is 10 lakh, which is almost 2.82%, and 9,400 rupees is paying on health and car insurance, which is 0.94%. So that is his penetration. Now if you look at the density of it, try to understand. Penetration is separate thing and density is separate thing. If you look at the density of Rahul, right, so density means total premium he is paying. Density just means total premium. How much premium he is paying? Almost, if you add both of them, this will be how much? 37,600, right? This much rupees he is paying per year on insurance, be it life insurance or no life insurance, right? So if you calculate the density, which is nearby equal to $78, which is same as the national average, right? So let's summarize what we have discussed in this slide, right? First of all, we talked about the penetration. Just remember, we have just talked about the penetration. So what is penetration? Penetration means insurance premium as a percentage of GDP. Remember, these are numerically being asked, so you must remember the formula of penetration. Insurance premium as a percentage of GDP by GDP into 100. That is the formula for penetration. And I told you that this was 3.76% in the year 2019. So this is penetration. Then we talked about density. What is density? Density means average spending per person. average spending per person, that is called density. So how much is the density? I told you that was $78 in the year 2019. Then we talked about life insurance dominate, right? Life insurance, how life insurance dominate? I give you one example. Life insurance dominate, right? I told you that 2.82% penetration is there, right? And $58 density is there. That's why life insurance dominate. And I told you non-life insurance lag. Why non-life lag? The reason behind non-life lagging is 0.94% penetration and $19 density. That's why in the perspective of India I'm telling you. And India's growth, I told you, after 2014 dip, India's penetration rise. After 2014 dip, India's penetration rise is still there is a room to grow, but filling up faster than before. I hope that makes sense to you. Now friends, have a look at snapshot of the insurance company and key legislation in India. Right. So first of all, let's look at some data. So here some data has been given. Let's have a look. So friends, imagine Indian insurance sector as a big cricket tournament. How many teams are there? 68 total teams are there. Means 68 insurers are there. Right, 68 insurers are there. How many life insurance team are there? 24 life insurance team are there. Like IPL franchises, but for life coverage. Then 27 general insurance teams are there who are covering car, home, etc. Like T20 specialist. And health insurance specialist is how much? 6. Like dedicated doctor for insurance. And how much reinsurer are there? 11 reinsurer are there. So these reinsurer, they are the backup player. They are the backup player. Okay, so this is the bifurcation. Okay, life insurance 24, general insurance 27, health insurance 6, and reinsurer 11. If you look at the public versus private bifurcation, so you can see government owned PSUs, how much insurer? 8 insurer are there. And LIC is the MS Dhoni of this team, right? Public sector. And if you look at the private sector, there are 60 insurer, right? There are how much? 60 insurer, like HDFC Life, ICICI Lombard, etc. And the Virat Kohlis are there. Okay, just like how Reliance Jio disrupted telecom, private insurer changed India's insurance game post 2000. You can see, Jio, you know it very well. Reliance Jio, how it disrupted the telecom industry. Similarly, private insurer changed the India's insurance game post 2000. Now comes the rule book. Yes, first of all, the Insurance Act of 1938. This is the constitution of insurance. It protects you from shady policy. It protects you from what? Shady policy. This insurance act protects you from shady policy. And this is older than India's independence. You can see obviously. Then we have, LIC Act 1956. Life Insurance Act 1956. It is created the big daddy of the insurer. It created the, big daddy of what? Insurer. LIC. Like the law that established RBI for the bank. Then we have JAIIB, that is General Insurance Business Nationalization Act 1972. So as per this act, it did nationalize general insurance and it created GIC and it also created 4 subsidiary. Remember, GIC and 4 subsidiary were created. Why? Why it was created? To prevent exploitation, like how UPI standardized the payment. And friends, if you look at some bonus throwback I provide you, you can see it here. 1912 Act. This was the Indian Life Insurance Companies Act. First attempt to regulate insurer. Then comes Indian Insurance Companies Act 1928. It started collecting insurance data. And the controller of insurance was the referee. He was the referee, right? Like finance ministry empire. So suppose, why all this matter to you? Let's understand. Suppose you buy a policy. Suppose you buy a policy from XYZ insurer, right? So this 1938 Act will ensure that they can't cheat. Because I told you now, this 1938 is like constitution of insurance. It protects you from shady policy. Then comes after that, if it is life insurance, suppose your policy, if you have taken life insurance policy, right? So LIC Act set the benchmark. LIC Act was formed in which year? 1956. They will set the benchmark, right? So and then suppose if it is non-life insurance, if it is suppose car insurance or suppose it is health insurance, then comes GIBNA Act. Right, GIBNA's Act. When it come, I think you know it, 1972. That's it, the benchmark. I hope that makes sense. Okay. So let's summarize the fact which we have just covered now. Here I am summarizing. First of all, what we talked about is, that there are 68 insurer. Out of 68 insurer, 24 life are there, 27 GIC are there, general are there, and 6 health insurer are there. Then we talk about PSU. PSU are 8, including LIC, and private are 60. If you further bifurcate it, 60 private are there. Top 3 law, if we talk about top 3 law, first is the 1938 Act, which is policyholders shield. Policyholders shield. Then we talked about 1956 Act. So 1956 Act is all about LIC. And then we talked about 1972 Act, which is called GIVNA Act. GIVNA means Nationalized General Insurance. And these are overseas by whom? Controller of Insurance. Controller of Insurance. So India's insurance ecosystem mix private agility with public safeguard. So friends, let's end our discussion here. Let's summarize what we have covered till now. Just give me 5 minutes and I will this revision is super important, right? What we have just covered till now, let's understand, let's summarize. First of all, we talked about insurance act like a safety net, right? It's safeguard you from financial losses, and policies are the rule book which provides you the coverage, and only unpredictable laws are taken into insurance, right? And here the parties are insurer, insured, agent, and IRDAI. These are the parties. Okay, so predictable loss are not covered, only unpredictable losses are covered. I told you earlier. Now let's, in the next slide, what we talked about. So we talked about that ancient insurance in marine loans, right? Oriental Life was the first insurance in India, 1818. Bombay Mutual Fund, second one, 1871, right? Then we talked about registration was registration of insurance in 1912, 1938, and 1950. We will talk in detail about it. Okay. Then in the next slide, what we talked about, in 1956, LIC was nationalized, right? So LIC was formed, not nationalized. LIC was formed, right? In 1956. General insurance was formed in 1973, and there are in 1973 GIC was formed along with 4 subsidiaries. Why? To stop the fraud, to ensure stability, and to ensure public friendly. And LIC was formed by merging to 45 private insurance company. That was huge. Now in the next slide, what we talked about is that what is the reason behind GDP bringing FDI cap in this insurance sector. I told you about in 2000 year private player were also introduced, and 26% FDI cap was there, and then it was raised to 49% in 2015, and then further to 74%, and 100% FDI is allowed in intermediary. You might have heard the name of Policy Bazaar. 100% FDI is allowed in such kind of intermediary. And if we talk about the global market, so global market, India's penetration is very low, that is 1.69% against the average of 3% of global. However, it is growing at faster rate, that is 9.21%. And in the context of India, life insurance always dominate. Just now we have talked about. Then further we talked about penetration. What is penetration? Penetration means insurance premium per unit GDP multiplied by 100. Okay, for 1 unit of GDP, how much insurance premium you are paying, that is called penetration. And similarly, density means average spending per person, that is called density, right? So we talked about penetration, that was 3.76% in 2019, and if we talk about density, it was $78 in 2019. So these are the data. In terms of 2019, you can see the penetration and density. And out of that, life insurance account for 2.82% penetration and $58. Right, and non-life insurance account for 0.94% and 19. That is the point. Now comes 2014 dip. Yes, 2014, what happened? There was some dip. After that, India's penetration is increasing. So remember these two formula: penetration is equal to premium upon GDP, and density is equal to premium upon premium per person is paying. So premium is same